everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. All right, welcome back to the program. My first guest is joining me, Olaolu Boboye. He is the lead economist and a fixed income strategist at Cardinal Stone. Hello, Olaolu, and welcome to the program.
Yeah, hi, good morning.
Good morning.
Thank you for having me.
Yes, Olaolu, good morning and welcome to the program. Now, Olaolu, let me begin by asking you that how significant is the 2019 rebasing impacting the numbers that we're seeing from the NBS? Of course, the GDP numbers just released show that Nigeria's GDP grew about 3.98% for the third quarter,
Yeah.
yes, of this year. How significantly does the 2019 rebasing perhaps alter the interpretation of this macro outlook for us, or macro review?
Okay, so
Yes.
first, I think that the rebasing of the GDP, number one, was necessary. We've provided different arguments in the past on why it was necessary to better capture the realities that we currently have. Take, for example, before the rebasing was done, a research that was conducted by the IMF indicated that the informal sector accounted for close to 50% of the Nigerian's GDP. And activities were going on in that space, but were barely captured because the last time it was done before the last rebasing was years ago, right? So the rebasing was necessary to capture activities. Now, how is the rebasing influencing things? I think that the numbers that we have are reasonable. They show reality. They are not necessarily changing or altering the trajectory of Nigeria. However, where I think that the rebasing might have brought about a major shift is in the agri sector. Yeah, you recall that the agri sector has been plagued by insecurity issues, low fertilization, low crop yield when you compare it to other African or emerging markets, right? But what we see now at the moment is that agri sector is costing around over 3%. Before the rebasing, agri
Olaolu, can
sector
you
was
hear me?
costing at low. Yes, I
Olaolu,
can hear you clearly. Can you hear me?
yes, I can. Just hold on a bit. I'll come back to you. We're going for a live event right now. So let's go for that live event. But I promise our viewers we will be bringing this interview. We'll be bringing you back this discussion, of course, on other programs. So let's join the live event. All right, Olaolu, continue on your point and land, because you were talking to me earlier regarding how the 2019 rebasing impacts our interpretation of this. So go ahead, Olaolu.
Yes. So I was saying that the current numbers that we have are pretty much reasonable.
Okay.
However, where we have the rebasing altering things is in the agri sector. Before the rebasing, the agri sector was costing around 1% levels, even at a point close to materially lower than 1% levels. But what we have at the moment is that the agri sector is over 3%, right, as of the last number that was released. And this is a bit concerning, given the fact that when you look at what is obtainable out there, insecurity issue is pretty much prevalent. When you look at what crop yield in Nigeria is doing compared to other African countries, it's lower than most African countries. When you compare output in the agri sector, right, it's lower in Nigeria compared to other countries. So clearly, the basin had more impact on the agri sector compared to any other sector.
Let's take a look at the underlying drivers within the non-oil sector. Of course, the non-oil sector continues to contribute to the GDP, but let's quickly look at perhaps the sectors even within the non-oil sector that most materially contributed to the 3.98% that we saw in the third quarter of this year. And don't forget that in the second quarter, it was 4.23%. So how are the categories within the non-oil sector performing? And what does it really say about the broader economy?
Okay, if you permit, let me just provide a bit of background. So people might be a bit confused on why the GDP was over 4% in Q2, and now is around 3.98 as of Q3. The reason for this is because it's likely in line with expectation, basically. It's because of softer oil output, right? And because of these effects that pop up the number in Q2. So the number we have as of Q3 released here are a clear reflection of absence of base effects. Now, let's disintegrate what is happening in the non-oil sector. Biggest influence is still coming from the services sector. Now, if you give the breakdown of services sector, you want to look at what is happening, one, in the trade sector. So trade sector improved materially to what we saw in the prior quarter. Reason for this is a function of what is obtainable in the macroeconomic space, right? Inflation is easing, exchange rate is relatively stable. A combination of these two is positive for domestic consumption. And when domestic consumption, which is about 60% of the entire economy, is strengthened, what you would typically see is that trading activities will improve. And that was why trade GDP, which is a significant proportion of the entire GDP, improved. Secondly, is that we saw the financial services, which is banks and insurance, improving. Why? Number one, in the second quarter of the year, we saw that OMO yields average about 28%. This is higher than what we saw in Q2. So banks were able to enjoy good yield, which was higher than inflation numbers, right? Which supported their performance. Secondly, is that banks enjoyed strong earnings and fees commission. That also supported their performance, and that was what drove the numbers that we saw. However, we noticed that despite the improvements in banking activities, and despite the fact that banks were able to raise money to meet the recapitalization that was set by the CBN, they did not necessarily give out adequate credit to the private sector. In fact, credit to the private sector declined. And that was partly what contributed to, or that was reflective in what we saw in the manufacturing space. So the manufacturing growth was largely constrained because elevated interest rates are still pretty much elevated, and borrowing costs was why we saw that the manufacturing sector remained constrained. And another sector of interest might be the real estate sector, right? The growth in the real estate sector also moderated. And this perhaps reflects the elevated real estate asset prices and the fact that people might be struggling to meet up with some of those real estate asset pricing. That was what largely influenced what we saw in the non-oil sector.
Okay, for Olaolu, I hope you can hear me. We're still seeing that manufacturing is still below the 2% growth, and that tells a lot for an economy that says, yes, that tells a lot for an economy that says it wants to be Nigeria first, for an economy that wants to pie itself up, for an economy that wants to be inclusive. And for manufacturing to still be below at 2%, what micro-level distortions really are most binding on industrial output? That means that we are not producing. That perhaps we are doing a lot more importation, even though the trade numbers tell us a bit otherwise, but there's still a lot of, underlying risk that we still really need to look at. What do we really need to boost manufacturing? Because this sector has been suffering for years.
I'll provide a bit of background. The CBN typically release survey, that
The
they do to
PMI.
the manufacturing space and
Yes,
others.
that's the PMI.
No, they have the PMI is there. They also have business confidence
Cost
survey and
survey,
other
yes,
surveys that they do.
yes.
Yes, in one of those surveys, manufacturers will ask what are their biggest constraints, and on the top of the list was borrowing costs, interest rates. Currently in Nigeria, MPR is around 26%. If you go to the bank to borrow today, the minimum can borrow is close to 30% because banks will have to add their own premium to it, and also depending on your risk factor. Now, if you are doing 30% interest rates, compare that to your profitability. How do you survive? And that's partly what has been dragging the manufacturing space. Yes, we like what is going on in the FX space. FX is stable, it's good for them. Inflation is stable, domestic consumption is improving. However, for us to see manufacturing sector go back to above 2% levels or even 3% levels, the starting point has to be interest rates. And one of the things that we've learned from the CBN is at the last banking um, dinner that the CBN presented, it was clear that the expectation is for inflation to moderate materially next year and for rate cuts to come in next year. So we see leg room for about 300 basis point rate cuts or even more in rate cuts. And I think that that will materially prop up and support the manufacturing sector.
Um, with these numbers that we're seeing, 3.98%, do you think that we're seeing any sign of labor market improvements at all, or real sector job formation?
So, in terms of that, one thing is clear is the most of the jobs that we have in Nigeria, about um, over 90%, are skewed towards the informal sector,
Informal,
which are
yes.
not necessarily captured by official numbers, right? But if we look at from the formal space, yes, we are seeing employment increasing there here and there, a few number of jobs, especially from the private sector. Yes, we are seeing jobs popping up, but we need more concrete numbers from the government to be able to provide that clue, in terms of the magnitude of the job increases that we are seeing.
So, so, Olaolu, are you still there? Can you hear me?
Yes, I can hear you clearly.
Okay. So as we round up this interview, what policy priorities do you think that this government should prioritize, or most effectively, how should they convert this growth into broad-based welfare gains? Because when the numbers are released, it almost seems like a ritual now, and a lot of people say, "Oh, now GDP growth we go chop," as it were. But GDP tells us a larger story. But when you actually also cascade into those numbers, it tells you even micro stories, nano stories within those numbers. So how can we convert this into real welfare gains so that it will not be that, oh, now GDP numbers we go chop. No be we say we no go fit chop GDP numbers. You understand what I mean?
Yes, I do.
Yes.
Clearly, that's how do we make the growth inclusive so that people
Inclusive.
can benefit.
Yes.
Yes, so that people can benefit from it. The first step that we need to do is one, the government needs to put in more efforts in terms of the physical side reforms. Yes, the government have done reforms, but most of the gains or most of the heavyweight reforms, the benefit are skewed from the monetary side of things. Now, how do we do this? Number one, job numbers have to improve. Now, I said the other time that most of the jobs that we have in Nigeria, they are mostly skewed to the informal sector. If you look at the characteristics of the informal sector, you will notice two things or more. Number one, the jobs there, the income from those jobs are not necessarily as significant as what is obtainable in the formal sector. Number two, the level of productivity in the informal sector has been researched to be 40% lower than that of the formal sector. So what we need to do is to create more jobs and create more productive jobs, right? How do we create more jobs? Government efforts, government intervention, and stimulation of the private sector. The combination of both is what will drive more jobs and more productive jobs. That will materially improve the life, the per capita or the standard of living from the formal sector. Secondly, is that um, I think that when we see sustained deceleration in inflation, because again,
Yeah.
inflation is at 16%, people are celebrating it. I totally acknowledge and love the inflation numbers. But for some of us that saw inflation at single digit. I remember writing a report years back complaining that inflation at 12% is high because
Yes.
long-run inflation in Nigeria before the shock that we saw in 2023 and 2024 is about 14%. So we are higher than the long-run average inflation at the moment. Until we see inflation come down materially, maybe close to single digits, maybe about 10%, or even slightly
9.
above
Yes.
single digits, maybe 9. That can also support the overall welfare and benefit to the formal economy, right, and to the informal sector. That will be able to drive activity. So I think those two things will be what we should focus on: bringing down inflation and making jobs productive and increasing the numbers of jobs.
Okay. Thank you very much, Olaolu, for joining us today, for putting in some kind of perspectives into this topic. Of course, we cannot finish peeling off the layers of these GDP numbers, but thank you at least for giving us a startup. All right, so see ya,
Thank you for me.
Olaolu. Yes, thank you.
Yeah.
All right, I've been speaking with Olaolu Boboye, who is the lead economist and fixed income strategist at Cardinal Stone. Let's take a quick break, and when we come back, it will be time for us to get into another crucial fiscal matter. We'll be looking at the capital gains tax, the misconceptions and even the myth, and the fact. We'll try as much as possible to sieve the noise. And you get the real facts. That will be when we return with my guest, Mr. Albert Olaolu who is the managing consultant at Preston Pidado. We'll be right back. Preston Pidado, we'll be right back. Thank you for making it up to this minute watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.